Good morning from London. This is Bloomberg Markets Today. I'm Guy Johnson with Kriti Gupta, who's in Brussels this morning. Anna is out today. We're less than an hour away from trading this morning. It's going to be a busy morning, so what do you need to know? The dollar is soaring, stocks and bonds sinking, investors adapting to growing expectations for US rates to stay higher for longer. S&P futures point to few signs of a meaningful bounce on Wall Street a little bit later. The German Chancellor, Olaf Scholz, takes a tough stance on trade in a meeting with the Chinese President Xi Jinping in Beijing. Data out of China this morning suggesting that economy is still struggling as efforts to stall the slide of the yuan against the dollar are as well. And Israel vows to respond with senior military officers saying the country has no choice but to hit back against Iran. Allies, Kriti, urging restraint.
And in the face of that, let's get a quick check on these markets here, because you are seeing a sell-off, at least indicated by the futures picture. Euro Stoxx 50 futures down 1%, a bit of a catch-up trade to what you saw in the States yesterday. Euro dollar 106, but Guy, to your point, it's all about that currency trade. More weakness in the yen, more weakness in the offshore yuan. Dollar yen 154, offshore yuan 727. Markets today starts right now.
Good morning, folks. Tuesday, the 16th of April. Busy day for the markets. The first thing I want to find out, though, is Kriti Gupta's first impressions of Brussels. What do you think? You enjoying yourself?
Look, Brussels is a beautiful city. It's kind of like a European Washington, D.C., but nobody told me about the weather. And I probably should have looked it up. I was looking for some sort of, European vacay, and that's not what it is. It's rainy, it's cold, but there's plenty going on in the ground, which makes it very exciting.
You got some interesting people to talk to. We'll do that a little bit later. It's not Florence. I think it's probably Kriti's take early on in the experience of Brussels. Very, very different kind of experience. Let's talk about these markets. So yesterday was a huge day, wasn't it? Retail sales, big move in the bond market, yields climbing higher, stocks under a little bit of pressure. Kind of feels that narrative has bled into the Asian session overnight. The Chinese data doesn't look particularly clever either. And I guess the question we're all asking this morning is, do you buy the dip at this point? And I think a lot of traders are going to be getting to their desks first thing this morning and trying to answer that question. But I think it's a really difficult one. Is this strong U.S. economy going to break something at some point? Is this strong dollar at some point going to break something, Kriti?
Well, I think what's interesting here is so much of that is based on what actually drove the move yesterday. And you're seeing varying kind of takes on it because, to your point, that retail sales data came in quite strong from the States. That big kind of jump that you saw in the March data, people aren't dismissing it as a one-off at all. In fact, that they're saying just because this pushes back perhaps the Fed's need to cut rates sooner, that's where the sell-off is perhaps coming from, as opposed to some sort of concern about growth or fundamentals. Is this where you buy the dip? To your point, it feels like all indications are yes, although I will say this morning's move in the currency market have less to do with what's going on in the States and more to do with what's going on in Asia.
Yeah, there's a lot of angles to that Asian trade. You've been raising what's happening with Korea. I think that's something that we want to keep an eye on. The Chinese are definitely struggling to keep a handle on their currency. Do they at some point let it go? We're looking at 160 on dollar. Yeah, kind of where does that one break as well? But it's the dollar kind of wrecking ball going around the world. It's definitely a kind of our currency, your problem kind of a morning.
It absolutely is. And I think we talked about this kind of in the last couple of weeks with various currency strategists. The positioning here is really important. We are long dollar across the board. Even against the yen, you were starting to see this idea. And I think you mentioned the 160, that call coming over from the Bank of America currency desk, where they're saying 160 on the yen is completely plausible by the end of the year if the Fed does not cut. Now, that's significant because it's basically based on the idea that the yen is not functioning as a hedge anymore, given the geopolitical tensions, given the concerns around the Federal Reserve. That flight to safety doesn't show up in the Japanese yen. Where you are actually seeing more volatility, I would argue, that's unexpected this morning, you mentioned the South Korea, is coming from the Korean won. Look at the Bloomberg dollar index. Your biggest dollar contributor move is coming from the Korean won. And this is interesting because as you see kind of the yen versus the renminbi to the Korean won, there's a trade story there. This has a lot to do with export data as well.
So what do you make of this? What do you make of this UBS call? So we've been talking about higher for longer out of the States, and maybe that's what's driving part of this dollar story. I appreciate what you're saying about some of it being domestically driven out of Asia. UBS are now saying it is a real risk that rates go higher from here, that we could get to 6.5, that the Fed may ultimately have to hike that far. Larry Summers has been talking about that. Now, there's loads of reasons why in the near term you may not want to talk about that. But the fact that some in the market are discussing this as a possibility, Barnum Bowager was here yesterday. It was his note that this comes from. What do we think about that? Because this is the worst case scenario, Kriti, for markets. Is the idea that basically we end up with this no landing, then we end up with a hard landing. And it's kind of the latter part of that the market really needs to be nervous of.
It is, and I think it's also a question of what's driving that, right? As we're continuing to talk about the story of consumer resilience, do we also need to be talking about an uptick of inflation? Guy, I think at the start of the year, there was that contrarian call that said maybe the uptick in inflation would show up by the end of the year. That doesn't seem to be the narrative here. It seems to be continued consumer resilience, even though you are seeing the data points point that way. So I guess my question here is, do we need to pay more attention to the commodity sector? Is this an oil story, $100 oil ahead of the U.S. election as well? Is this a tariff story? Or is this simply the fact that we don't need the insurance rate cut that so many people are betting on? And it feels like it's more the latter than the former.
Yeah. It's not Barney's central call. I think we should just make that absolutely clear. The other thing I should probably throw in as well is there's been a lot of tax selling over the last few days. So I think we just need to bear that in mind when we look at what is happening with these markets. And maybe that moment has passed. We are, though, in the blackout period when it comes to buybacks, your favourite subject. And that maybe is also adding to the downside potentially for some of these equity markets. I'm really interested to see how Europe opens this morning. I'm really interested to see how the US opens a little bit later on. Still got the banking story to talk about as well. The other fact, it's really interesting because I think the markets are kind of grappling with a bunch of things here as well, and kind of Brussels is probably an interesting vantage point to take a look at this, Kriti. You've also got the geopolitical story, which is continuing to develop as well. The Israelis are talking about the fact they potentially need to hit back against Iran. Now, allies are certainly urging caution at this point, and we've got various trips planned over the next few days, European leaders going to the Middle East to try and calm things down. But you do wonder, to your point about what's happening with oil and gold and what else is going on in the commodity space, that if you continue to see this updraft as well, that becomes a more difficult narrative for other equity markets, for other markets to digest.
It is. And I think to your point, we've talked a lot about this kind of from a markets perspective. But here at Brussels, when you talk to the folks on the ground, everyone is watching what is happening in Congress. In the last 24 hours, Punchbowl News, which are basically former Politico journalists who kind of created this for our international audience, this newsletter that comes out is kind of inside baseball or inside cricket, if you will, for the European audience. When it comes to Congress, it's important that they're actually pointing out the fact that you could get that congressional aid to Israel, to Ukraine, and actually have potentially even other pieces of the defense picture show up from American Congress. This specifically coming from House Republicans that are then also embedding things like border security, embedding things like sanctions against Russia. That seems to be the talk of the town in Brussels because that changes the narrative on how they're going to be approaching the defense story. And Guy, you and I have been talking about this on the show for weeks, for months really, about whether or not Brussels and Europe broadly can actually deliver on some of those defense ambitions. It feels like this may be a turning point in how they actually strategize doing it. It really depends on that U.S. aid, and it really depends at the core of that whether or not House Republicans are actually able to pass this. And that seems to be the kind of canary in the coal mine for this week coming out of Brussels.
Absolutely. We'll watch that carefully, and that's going to feed back into the commodity story. We're going to reference that a little bit later on. Evie Hambro, BlackRock's global head of thematic and sector-based investing, is going to be joining us 7:30 a.m. London time. We'll kick around what is happening with the gold story. We're going to need to talk about what is happening with the metals more broadly. Take a look at what's happening with copper. You've got a big meeting taking place over the next few days on that space as well. Let's talk a little bit about the data we've had already this morning. I feel kind of slightly remiss in the fact that I haven't mentioned this already, but Ericsson out with some really strong numbers. We'll see exactly how it trades first thing, but the numbers, when I say strong, I mean they've blown past expectations by a considerable margin. I also just want to reference as well what is happening with the UK data, because I think this is maybe instructive as well. There seems to be this view that maybe the UK and the US can go they're sort of different ways when it comes to rate cuts. So we've got data out this morning, weekly earnings. Keep an eye on the earnings data, because actually this has come through stronger than anticipated. So weekly earnings, this is the 3-month year-on-year number. It's come through at 6. The expectation there, 5.8. The prime number was 6.1. So there is a slowdown coming through here. And you can certainly see that, Kriti, in the unemployment numbers too, which have risen. So it looks like policy in the UK, and maybe the way that it's not over in the United States, is starting to have an impact in terms of the economic data that we're watching here, maybe opening the door to the Bank of England to be able to cut maybe significantly before the Fed.
Absolutely. And look, I think the market reaction is really relevant here because we've been talking about this dollar persistence and really the dollar driving the European currency story. You are seeing that break now. You are seeing cable off this data at about 124, not just a 124 handle, which it already was in the pre-market. 124.23 is where we're at, or 21 now, you can see on your screen. This idea here that you were starting to see those BOE rate cuts getting pushed out further and further. Is that what the currency story is telling us? You mentioned the Ericsson story as well. From a corporate perspective, yes, the number, it's a big blowout number, but there is still a forecast of underlying demand weakness as well. So I think when we're talking about the weakness story in Europe, pay attention to the FX market because that's where it feels like investors may be starting to wake up a little bit and say, all right, if the Fed isn't going to drive the train, maybe we need to price something else in.
I may need to slightly recalibrate my Ericsson story. We'll come back to that a little bit later on. The latest read I've just read is talking about an earnings slumping 27%. Demand decline set to persist. Maybe that's the latest headline. The initial flash certainly looked pretty good. Talking of the UK economy, we're going to be speaking to the UK's Chancellor of the Exchequer. He, of course, is Jeremy Hunt. That conversation happening at 7 p.m. UK time. He's over in the United States. We'll be looking forward to that conversation too. Let's talk about what else was going to be happening. These are all UK times, 1:30 p.m. We're going to get US housing starts. Pay attention to that. Remember, it's the new side of the market that has been doing well because basically the old side of the market, the existing, has been pretty much locked up because of higher rates. We're going to get US industrial production data as well. I think that could be fascinating given what the PMI, the ISM data are telling us. This is the one that I'm going to be watching for. 4:45, roughly UK time, you're going to get LVMH sales and revenue, which is going to be fascinating as well. Was that caring warning prescient? And later, of course, we're going to get Bank of America, Morgan Stanley, you're going to get United Health out with numbers. J&J is going to be out with numbers as well. So big day coming in terms of the central bank story. Also, plenty of ECB, Fed, BOE speakers all the way, basically littered throughout the day, Kriti. But the corporate earnings season is starting. Goldman was really strong yesterday. We started the show talking about bond volatility. They certainly benefited from that.
They certainly did in a way that, say, the likes of JP Morgan have not. And that's kind of very counter consensus you've seen to the banking story where over and over again, these banks, JP Morgan in particular, has profited from the bond volatility and Goldman has kind of been the laggard. Now the tables have been completely turned. It does that, however, set the precedent for the likes of Bank of America, for Morgan Stanley. I thought what was interesting as well about Goldman is that they're saying that the capital markets activity, the IPO story, is starting to pick up again, and they saw real benefits coming from that.
Yeah, is that something that could be sustainable? There's a lot of things changing in this market right now. If you were coming to market, would you want to be entering a market that looks as volatile as it is right now? I just kind of wonder how much in flux that process is going to be. Anyway, let's talk about what's coming up on the show, Kriti. We've got lots to talk about over the next couple of hours. Oil climbing, Israel vowing to respond to an unprecedented attack by Iran. Gold steady near record highs. Evie Hambro is going to be joining us. Looking forward to that conversation with him. Plus, Citi says that Hermes has the potential to surpass Louis Vuitton as the luxury industry's biggest brand. We're going to look ahead. LVMH sales and revenue a little later on. We need to talk about that story too. Any questions? Join the debate this morning. We'd love to hear from you. You can do it in a number of different ways. IB Plus TV Go is certainly one of the easiest. Looking forward to hearing from you. This is Bloomberg.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. Now, my own view is that that process will likely start this year, but again, it's going to be driven by the data and achieving our goals.
The worst thing we can do right now is act urgently when urgency isn't necessary. The policy's in a good place. We're in the ready position. We can respond as the economy evolves. The labor market's not giving us any indication it's faltering, and inflation is still above our target, and we need to be confident it is on path to come down to our target before we would feel the need, and I would feel the need, to react.
New York Fed President John Williams, San Francisco Fed President Mary Daly, sounding like they're on different pages. I'm not entirely sure that they are. The data really are ultimately going to determine what happens here. The big question I think a lot of people are asking this morning, though, given the moves that we saw yesterday, particularly in yields, but in equity markets as well, is do you buy this dip? And if you take a look at the early indications, certainly out of Europe, there's a lot of catch-up trade to be done here. So just you've got to look backwards here and think about what is happening. So there's a little bit of catch-up. U.S. markets were ugly yesterday afternoon, so we need to think about that. U.S. futures, though, I'm looking at the fair value calculation on the Bloomberg. I'm looking at the S&P. There is no dip buying yet. We are still just fractionally negative in terms of where we are with U.S. futures right now. Let's get a take on what's happening with this economy. Klaus Bader, Global Chief Economist at SocGen, sitting next to me. Good morning. You've been arguing for a no-landing story for a while. Is this it?
Yeah, I think that, so the U.S. economy is going to keep cruising. There isn't really anything that I can see on the horizon that's going to significantly break it. Monetary policy doesn't strike me as being particularly tight. It's maybe tight-ish. But if you look back a little bit further beyond just the great financial crisis, against which, if you look only back to then, then interest rates look relatively high in real and in nominal terms. You look a little bit further, and I'm not talking 70s or 80s. I'm talking second half of the 90s or the 2000s before the great financial crisis. And I think you could describe monetary policy as slightly tight. And, the economy appears to be more resilient to the monetary policy stance than you would have expected. And I think there are a number of reasons for that. We probably don't have time to talk about all of them.
Let's get into some of it. Does a no landing equal a hard landing ultimately?
Well, it depends. It really depends how inflation behaves, I think. Because if inflation really refuses to slow and the monetary policy stance tightens a lot more, then you might get a hard landing. But I think the economy, it's going to have to slow down because the latest numbers suggest that in the first quarter of this year, we again saw GDP growth substantially above potential. Can't have that forever. But now, look at the labor market. The potential growth rate of the U.S. economy has clearly increased, and immigration is at least part of that.
Klaus, it's Kriti in Brussels today. Talk to us about this immigration story, though. It feels like we've been talking about the border crisis, immigration in the States, and arguably immigration everywhere for a very long time, and it is just now kind of being calculated into the effect on productivity and the effect on the labor market. Can you quantify that for us? Is this a positive, or is this still something that's going to take 5-10 years to play out?
It just depends on how fast the inflow is. But no, I think that this is already happening right now. The U.S. economy is generating employment, to 300,000 a month, which, is 2 or 3 times what people not very long ago assumed was the natural growth rate of the labor force. But we've seen slight upticks in the unemployment rate, indicating that the labor force is growing very rapidly. And it doesn't seem to be first and foremost driven by higher participation, but rather, as I said, by immigration. So, no, I don't think that this is a story that's only going to play out over decades. And, we'll see what the immigration policies are going to be. It is, after all, a hotly discussed topic in U.S. politics.
Klaus, you're also now seeing calls that, especially in the context of the currency moves that we just saw overnight, but calls that are starting to say, if the Fed doesn't cut by the end of the year, what is the possibility of that?
The possibility of what? That the Fed doesn't cut before the end of the year?
Correct.
I think that's now our base case. The economy is continuing to expand very solidly. All of the data, whether it's the labor market data, yesterday's retail sales numbers, et cetera, the economy is growing very solidly. So what's the hurry? Why should the Fed be under pressure to cut interest rates? And, frankly, the inflation trends are really not at all favorable. The year-on-year rates are one thing, but year-on-year rates can be very deceiving. If you look at shorter-term comparisons, so for instance, 3-month on 3-month average annualized, or the change in the CPI or PCE deflator over 3 months annualized, you see that there's been a very significant acceleration. And actually, the same is true, although the ECB is in total denial, the same is true also in the euro area. Is this just a 3-month phenomenon that evolved over the first part of this year? We'll have to see. But I can certainly understand the position of, for instance, Mary Daly, who says, we've got to have more confidence that the inflation trend is easing. The recent data don't give any confidence that that's actually the case.
Is the risk rising that the next move from the Fed is a hike? How high is that risk?
Yes, that risk is rising. I think it's still a pretty remote risk.
Okay.
But I think it's absolutely a risk. And this is something, I've talked about this here before.
I know. I'm just teasing it out of you.
I have argued that markets are dangerously one-sided positioned. They have this idea, yes, policy tightened relatively quickly, and, the famous, infamous, long and variable lags in monetary policy. But, so it was right that central banks then paused. But markets were universally one-sided position that after that plateau or the table,
we'll claim some responsibility for that.
That then they're going to go down, that there's the only way is down. And I've said for a long time, yes, that's the most likely scenario, but the idea that they can't go higher shouldn't be discounted. I still don't think that it's definitely not the most likely scenario, but the probability is rising, in the US at least.
So a cut at this point would be a policy mistake. What about from the ECB? You talked there about the fact that the ECB probably should be thinking about what's happening with inflation as well. Lagarde sounds quite confident that she can cut rates. The data certainly are moving in her direction. The Bank of England looks probably in an even better position, potentially, to cut rates. Do you think should Europe be cutting rates right now? And if so, how far can Europe diverge if the Fed, if there's a risk that they hold for a long time and there's even a risk that they hike next?
Yes, I mean, the ECB I think the ECB has its communication policies slightly in a muddle. In a muddle.
All right.
They have been indicating very strongly that they're going to cut rates in June.
Yep.
And then they say they're going to be data dependent. So the question is, are they not data dependent in June? I think the economy in the euro area is weak enough, and the overall inflation picture justifies some easing of monetary policy. But again,
not much divergence.
I think that they can diverge quite a lot. So you see, as long as the inflation picture is okay, a weaker euro isn't really going to do much damage, right? An economy that is growing very slowly, if at all, I mean, we've basically been flatlining, a slightly weaker exchange rate wouldn't be the worst thing to happen. And that's, I think, where the connection between different central banks really comes in. It's in the exchange rate.
It was good to see you. Thanks for stopping by to see us. Such a pleasure. Klaus Bader joining us from SocGen, Global Chief Economist there. OK, we need to factor what we've just heard into what comes next, which is what is happening with the commodities story. We're going to track the latest moves in commodities. You had mixed Chinese data out overnight. You got a big meeting on copper taking place in Santiago. Iron ore's down on the Chinese data. Copper's really interesting right now. Gold's absolutely flying. Is that an inflation story? Is that a dollar weaponization story? So many questions for our next guest. Evie Hambro from BlackRock is going to be joining us. We'll get his take on all of what is happening here. Early indications this morning. Look, we're looking at an equity market here in Europe that certainly looks very soft. The question a lot of people are going to be asking this morning is, do I buy the dip? Let's see whether or not they do a little bit later on. Anyway, this is Bloomberg.
Welcome back to Markets Today. We're about 30 minutes away from the start of today's trade. Let's get a quick check on these markets here because you are seeing futures indicated lower on the continent. Perhaps a little bit of a catch-up trade when it comes to what you saw in the U.S. session yesterday. Simply this idea that there is a lot of kind of pain in the U.S. session. Does the Europe kind of outperform in that way? Do you see that bid into the minors, for example, show up at the open? Or is it simply just processing what we got in the U.S. session? Not to mention some of the kind of carnage you are seeing in the Asian session as well. In the meantime, a quick check on the bond market as well. You are seeing U.S. yields a little bit higher, and that is the same sentiment across some of the European yield story as well. Remember, the UK bond market has not opened yet, but we did get that UK jobs data in particular that did suggest a little bit of higher wages as well. You saw a weakness in the currency, weakness in the pound as well. Does that translate then to the gilts market? We'll, of course, bring you that live at about 8 a.m. local London time. How all of that translates into the commodity picture is interesting because as you see perhaps a little bit of a sanguine bond market pricing in some more inflation, you have to pay attention to what's happening in commodities. Yes, we're keeping an eye on oil, etc., but the metals are really important here. And it's not just gold. You are seeing gold, of course, hit that record trade just shy of that 2,400 level, but you are seeing lots of moves across copper, aluminum, nickel. So a lot of that is a supply ended up story. And that brings us to one ratio that we watch very, very closely. And that, of course, is the gold and silver ratio. I think this is really interesting because this is something that we talk about every time that gold hits that record high. And the terminal chart that you need to be watching is this one, simply this idea that every time gold has hit a record, that ratio, the exception being 2020, has really compressed and we are headed there again. Does that signal that gold is kind of doing its own thing, or is that a broader metals story? I want to bring in a true expert here. Evie Hanbro, global head of thematic and sector investing over at BlackRock, joins us this morning. Evie, a pleasure to have you on the program. Let's start with the gold story here. So much momentum into gold. Some would call it an inflation hedge. Others would call it just a reaction to the geopolitical risk. In your view, has gold kind of run out of momentum? Is this the peak in the yellow metal?
Well, good morning, Kriti, and thank you very much for having me on today. I'd say that, we're in a market right now where the commodities are being kind of gently bubbling away. The pressures are building across a suite of them. On your slot earlier this morning, you were talking about some of the droughts in Africa and the pressures that they're having there. We've seen the issues that have been playing out in cocoa as well. So I think that what we're seeing coming through in the market is fundamentals starting to have more of an impact on pricing of commodities. And we're starting to see financial investors wake up to this, having been complacent for quite a long time and taking supply for granted. Some of these markets are now starting to become very, very tight. I think the negative sentiment around China has been a big overhang on the market and has kind of cooled any form of kind of interest of looking at it. And now we're starting to see some of those pressures ease. We saw the economic data today that, good in parts, certainly better than people have been expecting a few months ago. So as that sentiment starts to kind of disappear, the fundamentals should start to come through, and commodities like gold and copper and others will move back towards fundamental pricing. And that's very exciting for groups like ourselves.
How much of this it kind of feels like you're talking about some sort of kind of return to normal or return to mean. I'm curious how much of this, in terms of the physical demand story, catches up. Just for one example, a guy and I have been chatting about on the show has been this defense story. If there's this kind of underlying need for raw materials for defense or underlying raw materials for EV or even infrastructure plans in the U.S. and China, is there going to be at some sort of a point a capacity shortage? Do you see that at all?
Yeah, one of the things that we look at over the kind of medium term across many of the kind of key industrial commodities is two things. On the supply side, you've just had a very long period of time now of underinvestment into new capacity. And that's been driven by a range of different factors. It could be the challenges of getting permits to be able to build new mines and new capacity. It can be some of the elongated practices of doing that, some of the pressures you have to now fix in that. The capital costs have gone up enormously. We've seen a huge increase in the cost of building new capacity. And commodity prices haven't really responded to that. So you've had this kind of reluctance of producers to add new capacity. At the same time, on the demand side, you've actually seen demand starting to rise across many of these commodities, and the rate of increase is actually accelerating. Now, that acceleration is coming from this energy transition, where we all know, and your brilliant work at the new energy part of Bloomberg, that is is telling us enormous amounts of data that shows that it is much more commodity intensive to have a lower carbon economy when it comes to energy than the one we've been used to for hundreds of years. So this kind of addiction to fossil fuels is starting to shift. The energy transition is playing out. We're going into an environment that's going to be much more materials intensive, and the sector hasn't accommodated that in terms of growing production to be able to meet that. So yes, in answer to your question, we are building towards this pressure point, and as a result, we've seen governments act. We've seen a lot of new policies. The US has the IRA, the European Green Deal, lots of initiatives around the world to encourage growth in production capacity because we see the challenges ahead of us.
Good morning.
Morning, Guy.
In that kind of environment, do I buy metals or do I buy miners?
Yeah, great question. I think when we look at it, there's a role for both.
Yep.
And that's not me not answering your question. It's just...
Sorry, I won't let you do that.
It's just saying that, some people like to have pure exposure to the commodities. They're happy to take the risk attached to futures contracts, which make up a lot of that commodity exposure in the products that are created or the indices. And some people actually want the growth in the companies. They want the exploration. They want the dividends. They want companies managing that commodity exposure for them and therefore go into the equities. There is obviously that equity volatility, which is in addition to the commodity price exposure. So as long as you're comfortable with that higher level of risk, and that can be compensated for with a higher rate of return, like a dividend and so on through time, then there's a role for both. What we see across our clients is that when they want to have the kind of more kind of positive view on the market, they're definitely going to go into the commodity equities. Absolutely, because you get that higher bang for your buck.
There's still room to go in that trade.
Well, when you look at the commodity equity valuations, they're trading way below their own historical averages in terms of multiples. They have rallied a little bit in the kind of last few weeks, but way below the historical multiples. When you look at PE multiples, you look at EV to EBITDA, you look at dividend yields, they're screening incredibly cheaply relative to their own history, let alone to the huge discount they're trading at to normal market multiples.
The dollar's on a tear again this morning. If the dollar continues to be on a tear, kind of how does that change the commodity world? If the dollar reverses, how does that change the commodity world? How key a variable is that in the way that you're looking at the market? Yeah,
so I think what we're seeing in currency markets is obviously this kind of to and fro between shall we, shan't we in terms of interest rates. And we started this year with, I think it was, 6 interest rate cuts being forecast in the US. And now we're down, I think the market's pricing in 40 basis points of cuts between now and the year end. So one and a bit. I don't think you can rule out 0 cuts or maybe something else if the data remains strong. And I think all of the commentary we've had back from the experts and the central bank governors is it's data dependent. And as this data continues to come through, it's kind of pushing back on the need to cut and delaying the timeframes. And obviously the dollar's responding to that.
Evie, we talked about commodities, we talked about the dollar. Those are your two kind of, at least in the last 5 years, major go-to hedges that people use. In the next 5 years or even in the next 12 months, what's the go-to hedge?
Well, what we're seeing right now, and you started off on this earlier on, is we are seeing people looking at gold. We've got a lot of geopolitical uncertainty in the world right now. We've got a lot of uncertainty around interest rates and are they going to be cut or not, what's moving in currencies. And what's been fascinating to us is just seeing that preservation of purchasing power that gold's been able to deliver. We've got some wonderful data attached to this. And you look at what gold is able to buy you through time and how much that preservation of that purchasing power has been able to help you. So fulfilling that role of a safe haven asset, keeping your wealth intact, it's not just the dollar people are turning to. And you're seeing it in central bank activity. Central banks have been buying gold on a real tear over the last couple of years. And we've seen a big pickup in interest there. So that to me is an exciting sign that we've kind of been focusing on.
It's interesting that we talk about that from a monetary policy lens, though. How much of that is also a result of the geopolitical risk we're seeing around the world? Are these markets pricing in the risk?
Yeah, I think in the short term, what you see is volatility in commodity markets generated by the events of today. But when you look at over the medium to long term, it's always the fundamentals that come through and price the commodities over that kind of trend line. And that's what we focus on, trying to second guess the market on a kind of 24-hour period or a day rate. That's not really the role of what we do in the team at BlackRock. What we're trying to do is make those longer-term investment decisions, backing the companies that are able to generate the value through time, extract the value from the assets they have, and reinvest the money that they're making wisely into future assets that the company is going to be able to grow and develop, as well as sharing some of those cash flows with the investors coming back in terms of dividends. So that's our focus in terms of what we do, rather than trying to second-guess short-term moves in the market.
Well, in that case, let's talk about this long-term investing plan that Europe has been very vocal about when it comes to the defense sector. Again, we started off this segment talking about capacity shortages and how realistically that can be taken. How realistically are you and your team taking that long-term European defense trend?
Well, it's not necessarily focusing just on defense. I mean, I think what we're thinking about more is the energy transition. Defense is something that has obviously become very, very topical over the last years because of some of the tragic events that have been happening. And obviously the need to kind of reinvest back into that area is very, very important. But what we're seeing more at a much bigger scale, and not just in Europe, but also globally, is this move away from the kind of heavy carbon economy that we've been used to for hundreds of years. And as I said earlier on, that energy transition is very, very materials intensive. And it's driving commodities demand growth rates at higher rates that we've been used to, at the same time that we're not seeing the investment into supply. And when you have those kind of two forces, it's a little bit like kind of tectonic activity in the world. And we know what happens when two tectonic plates start to move apart. You get an earthquake. And that's what we're seeing play out in the commodity markets. Those fundamentals that have been overlooked for so long are now starting to come through and have that pricing impact.
What impact are the latest sanctions on Russia, nickel, etc., going to have, do you think? I think everybody's trying to work out kind of the short-term impact and then the longer-term impact.
Yeah, I mean, I saw you guys covering this yesterday. I think the market had been expecting this move,
sure.
But obviously it further adds opaqueness to the market. That material is going to find a way of getting to a customer.
Is it just a rewire? So are we going to see a rewiring of the in the same way that we saw with oil when it comes to metals?
Exactly. So we've already seen that rewiring take place.
Right.
In other commodities, and we're probably going to see it take place in industrial commodities as well. So when we think about that, the beneficiaries of this are going to be the people who can still trade with Russia. Is Russia going to be able to sell that material at the market price, or will it be sold at a discount?
Yep.
I would imagine, given you've got a shortage of buyers because you put those restrictions in place,
yep.
Then the discount's probably going to grow, and that's going to be beneficial to those people who continue to trade with them. Other people are going to be disadvantaged by that because there are going to be shortages in other parts of the world. But yeah, the commodity markets have a really brilliant way of moving the pipes around and reconnecting demand with supply, and that's the role of commodity traders, and that's what the job that they do. So I'm not too worried about that, but I think what it does tell you is that the commodity markets are just tight, and this is an additional bit of information that's it's like that Bunsen burner turning underneath your pan, and the pot's already boiling, and you're just adding a little bit more heat to it, and at some point that's going to get exciting.
Yeah, the glass sometimes cracks. Evie, nice to see you.
Absolutely,
thank you. Thank you so much indeed. Evie Hambre, Global Head of Thematic and Sector Investing, joining us from BlackRock. I want to talk a bit about what's happening with the dollar this morning. You are seeing, certainly out in Asia, the dollar on something of a tear. We are approaching the 160 level on dollar yen. We've seen that earlier on. We're pushing higher. Today we continue to see that move taking us in that direction. 154 now, 154.58. The data out of the UK this morning may be suggesting the labour market is loosening. Euro dollar 106. Take a look at what is happening with the Chinese currency as well. What happens there? How much longer can the Chinese hold on? Are they ultimately going to let that one slide? If they do, that's a long-term strategic implication, but also a short-term problem, I think, for the rest of the world. Anyway, we'll talk more about that. We'll talk more about the Schultz trip to China as well. Plus, we need to talk about some of the corporate news that's coming through. Ericsson seeing an earnings slump, but the company hopes a deal with AT&T will help stabilise sales later this year. We're going to bring you that and the other stocks. Take a look at the paper sector this morning. That's one to watch too. This is Bloomberg. 47 minutes past the hour. Good morning. Welcome. It is Tuesday, the 16th of April. Futures indicating a negative start here in Europe. A little bit of catch-up that we need to be talking about versus the United States yesterday. But futures out of Wall Street, fair value calculation looks pretty flat too. Let's figure out what we therefore do this morning. Joining us now, our Markets Live Executive Editor, Mark Cudmore. Mark, the question everybody's asking as they sit down at their desk this morning is, do I buy the dip?
Good morning, Guy. Well, with the disclaimer that I am not giving any explicit trading advice, I think absolutely probably want to turn bullish from here. The context is, as you know, that I've been in kind of a structural bull all year ever since that December Fed, that idea of a no-landing bull market, as we've talked about it a lot over the last few months. A couple of weeks ago, I felt you should be more tactically underweight because of the risk that the yield narrative had run far enough. I now think you turn bullish because I think there's three reasons for the risk aversion recently. One is tax-rated selling, and that culminated yesterday. April 15th is the date that ended. Another component is the geopolitical tensions that we were pricing over the last 2 weeks that arguably might have culminated on Saturday, that of course is going to ebb and flow from here. The third thing is the yield story. Now, what we had last week was the kind of the yields tantrum. We had the sudden spike up in the move index, the volatility index of kind of treasuries, and that was the move that was based on inflation data. Yields can still go higher from here. I think they will go higher from here ultimately. But when they go higher from here for the next few weeks, it'll be because of strong economic data. So I think the drivers of weakness the last couple of weeks are now turning, and therefore I think ultimately you no longer want to be tactically underweight.
Does a no landing equal a hard landing? And if so, when? And when do I want to price it in?
Yes, a no landing will turn into a hard landing, but I think no time soon. I think you trade that narrative at many, many months away, maybe not even this year. Look, for the last 3 years, I've been in a camp that there's no such thing as a soft landing once you lose control of inflation. Historically, that's been the evidence, and theory-wise, that is what you learn in economics. And so therefore, I think ultimately this will be a hard landing, but it's so far away that you should not be trading that narrative yet. When will we trade it? I don't know, but we'll know we're much closer. So therefore, at the moment, do not worry about that. Be structurally bullish for many months to come.
You'll know when you know. Mark, great stuff. Thank you very much indeed. Executive Editor of the MLive team, Mark Cudmore. You want to figure out what the whole team's saying? You want to get the thoughts, and they are great thoughts, interesting thoughts, thought-provoking thoughts. MLive Go on your Bloomberg terminal is the function you want to be looking at there. It's taken me a little while to figure out Ericsson this morning. Early flash across my screen looks really good, much better than estimates, but it's a slump on last year. So how is the market going to trade that, I think, is the interesting one. Let's try and figure that one out. Joe Easton, over to you.
Morning, guys. So it does look like a potential positive open for Ericsson with focus on the analyst expectations versus the numbers what we've got today. Here we've got the main numbers on the screen. So adjusted EBITDA, smashing estimates, 4.3 billion kroner. Less than half of that was expected by the street this morning, and adjusted gross margins also comfortably beating estimates, with the firm predicting a rebound and improving sales over the next year ahead. Now, this stock has been on a terrible run over the past 3 years, as a lot of customers in 5G mobile phone firms have cut back on their projects, partly due to the fact that rising rates have made these projects more expensive. We can see it trading close to 130 Swedish krona 3 years ago, trading yesterday at 53.60, been on a really bad run. And if we look at what analysts are saying, there's still a big number of sell ratings on the stock, 8 sells, so potentially analyst expectations were low going into this. And I've just heard that on the Tradegate exchange it was up around 6% on the early indications, so potentially we are going to see that feed through in Stockholm today. Then we're also looking at Wise, previously known as TransferWise, the money transfer company. Now this one looks slightly weaker. They are missing on their revenue for the fourth quarter, but they do say that volumes are up around 30%. And they have seen a jump in customers over the past year as well. They're now doing around £30 billion worth of transfers in the latest quarter, according to the company. It has actually outperformed some of the big rivals recently. So we brought up PayPal and Western Union, the other big firms there. It's outperformed recently, but it only IPO'd back in 2021, and it's only recently just recovered to that level there, we can see on the chart there. So potentially a bit of a mixed one from that, but investors finally back to the level they they were at the IPO. Then we're also looking at airlines today. This is because Citi has a positive note out on transatlantic travel. They say that travelling across the Atlantic is getting more expensive, and that is going to benefit the airlines like some of these on the screen here, IAG, Air France and Lufthansa. They say capacity is around 16% below what it should be at the moment. So that means prices are higher. Corporate travel also booming as well. But yesterday we did have a drop for Deutsche Lufthansa late in the trading day because they announced a cut to their profit guidance due to actually industrial action over in Germany. Wages, that has hit their earnings. We can see that drop pretty significantly today. But the one to watch probably today is IAG. This is because in Citi's note they do say it is their top pick and they've got an upside cash list on that one. Here's the analyst ratings, 23 buys, only one sell. That's a pretty good make-up for them. Keep an eye on the airlines, in particular IAG this morning.
Joe, great stuff. Thank you very much indeed. Setting us up for the single stock story as we go into the start of trade this morning. Kriti, there's a bunch of things happening. I think there's a catch-up trade that is kind of working its way through here in Europe. I wonder how long it will take for that to work its way through the system. So equities looking quite ugly at the get-go. That's pricing in the back half of the session we saw yesterday in the United States. Futures on Wall Street looking fairly flat. The bond market sell-off, which was there yesterday, looks like it's kind of flatlining. Germany, bunds look like they're kind of flatlining this morning. We'll see how gilts open as well.
Yeah, it feels like the carnage this morning, at least in Europe, is going to be more in the stock market focus, perhaps even in the currency market. Already seeing cable seeing some bit of a weakness. I think what's important to keep in mind here, though, is that we're talking about it from a fundamentals, catch-up trade, pricing and monetary policy. There is a liquidity story here. There's a positioning story here. Remember, for the S&P 500 in particular, and by extension, the other kind of indices that follow it, correct by about 5%, 2 to 3 times a year. This is the first time thus far this year you're seeing that kind of 5% pullback. Right now, about 4%. So again, completely normal in terms of that buy the dip mentality.
Keep an eye on the VIX. Big spike over the last few days in the VIX. We're up kind of, we were at 12, we're now at kind of 19. VIX is certainly pointing us to a more volatile market. This is what the futures look like. Looks like it's going to be a soggy start to the day here in Europe. We'll deal with the details. Be interesting to see what it looks like an hour in. Anyway, the European market open is next. That's coming up. This is Bloomberg. Tuesday the 16th, good morning. Welcome. You are watching markets today. A couple of minutes to go until the start of equity trading here in Europe. Gilts are about to open as well. We're going to be pricing in the labour market data that we've seen this morning, Kriti, which looks a little on the softer side. Wages are up, but we're starting to see unemployment creeping up as well, and that has a tendency over time to accelerate. So we'll see what happens there. But the real story here is that we saw a negative close yesterday on Wall Street. That now in some ways needs to be translated here into Europe. So what's the overriding emotion? Is it fear or is it greed?
That is a very complicated question. And when you find out the answer, you let me know. But I think to me, this feels a little bit kind of technical here. Look, yes, you had some strong consumer data coming out of the States. And you also had some of the monetary policy bets kind of get turned around as well. The currency piece of the equation is important. Remember, you're not going to see this international bid for the S&P 500 if the dollar continues to be this strong, and that overnight move in the dollar perhaps dissuading some of the investors around the world. I mean, this is interesting to me. I think just this natural pullback of kind of 5%, 2 to 3 times a year is very normal for the S&P 500. It kind of feels like, for me, that's where we are right now.
It's been a long time since we had a decent correction. It's been a long time since we had VIX spiking high, and certainly that's been happening this month. The bond market move yesterday was absolutely brutal. To a certain extent, that may have been more priced in to the European story than maybe we've seen in the equity market. So at the moment, we are seeing bonds kind of fairly flattish here in Europe, but equities look like they're going to suffer. Look, fair value on my screen looks like a kind of 1.5% move to the downside here, Kriti, in terms of what we're going to see for European equities. Keep an eye on Ericsson, keep an eye on international paper, keep an eye on LVMH into the numbers a little bit later on as well. That's going to be an interesting trade as well. So here we go. European equity markets are open. We're expecting certainly the FTSE 100 to sink at the start, so we'll see what happens there. That is certainly the early trade that we're going to be anticipating in terms of, well, let me give you some points in terms of the big movers and where we're seeing the downside. Novo Nordisk is down by circa 2% this this morning. That's the biggest points drop. Some of the oil stocks are down as well. So Total is down. LVMH is soft into its numbers a little bit later on. But what you're looking at here is some big heavyweight names that are certainly suffering. I think Airbus, just keep an eye on Airbus. Airbus, I think, is ex-dividend today. So just kind of factor that into your thinking as well, where maybe you see that story moving. But if you think about kind of some of the stocks that we watch out for, Novo Nordisk is down, Astra's down, LVMH is down, Schneider is down, some of the banks are down. Now, the banks have been big gainers. That's the sector story in front of you there. That's not all of them, but you're kind of getting the picture there. This is a fairly negative picture that we are looking at here first thing this morning. Now, as I say, what do you do? Is it fear? Is it greed? What do you do first thing this morning? Do you buy this dip, or do you believe that maybe this sell-off has potentially still some way to go? That is a story that I think markets of investors and traders have got to figure out first thing this morning on how they're going to do. But certainly the early indications are that tech is under pressure. ASML is down. You've got Novo Nordisk also softening up. LVMH is down fairly significantly as well. That's where the kind of the point story is. In terms of where we're seeing some of the upside, top down market is up. You've got Nokia, interestingly, trading higher. Let me just get you a price on Ericsson. Let me just see what's happening with Ericsson first thing this morning. No, that's the ADR. Give me a moment, and I'll get you the right price if I can spell it on my Bloomberg. So we'll see what's happening there. So the early indications are that that stock was likely to open higher. Let's see if we've got an early price on Ericsson. Yet to see that one come through. So we'll watch and see what Ericsson does in a few minutes' time. But the kind of the setup to this trade is that basically what we saw yesterday was a retail sales number that was strong. We saw, therefore, yield spiking higher. You also had, remember, when it comes to the equity markets, maybe the end of tax selling, that's going to be a factor as well. The central banks are now in an interesting position, certainly over in the United States. This feels increasingly like a no landing. So what do you do? Are we going to be pushing out rate cuts until next year? Well, let's hear what Williams and Daly had to say on that subject.
Real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. Now, my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
The worst thing we can do right now is act urgently when urgency isn't necessary. The policy's in a good place. We're in the ready position. We can respond as the economy evolves. The labor market's not giving us any indication it's faltering, and inflation is still above our target, and we need to be confident it is on path to come down to our target before we would feel the need, and I would feel the need, to react.
Inflation's not coming down significantly. The labour market looks pretty solid. San Francisco Fed President Mary Daly there. John Williams taking maybe a more kind of consensual approach at the centre of the FOMC, certainly a voice that you want to be listening to at the New York Fed. So where does that leave us and where does it take us? Let's try and get an answer to that question. Christian Muller-Glissman, Head of Asset Allocation Research at Goldman Sachs, joins us now. Good morning. Feels like we're heading towards 5% on a US 10-year. How does that change the picture for you?
Yeah, it certainly feels like it. I think the important thing to note is I think 5% is not so crazy considering where the macro picture is right now.
Yep.
I think as long as growth is good, equities can deal with that and the economy possibly can deal with that for some time. I think the challenge is always with regards to bond yields, level, speed and source of the increases. I think level-wise, that's a long debate. I think we might argue that, closer to 5% is the new equilibrium we have without a recession around the corner, with a no-landing scenario.
Yep.
What the market doesn't like is the speed. I think it's been too fast a move, and it's come at a time where arguably the source has not been linked to growth as much. It's been more linked to policy, where the market is reassessing the kind of new neutral rate, and that is something that equities don't really like right now. And you have to consider that also in the last few days, you've had a few kind of things going on, like Middle East tensions. You're entering earnings season. Earnings information so far has been a bit mixed, you could say, with some of the Magnificent Seven at least being in focus. Yep. So it feels like a bit shaky.
A bit shaky. Can we get through the shakiness? Can we push on to further highs? Is this something that is going to become more problematic for equities? Oh, we've had a very good run This has been a sensational run for stocks. Yeah. Is it harder to make gains from here, given the headwinds that you've just discussed?
I think you make a very good point here. I think we've had a phenomenal start to the year. We had a phenomenal rally. If you look at positioning and sentiment indicators, they were elevated. And understandably, though, like there was huge momentum, kind of investors were possibly squeezed a bit into the market. So you have a bit of a setback. But stepping back to the fundamentals and the macro, in a broader scheme of things, growth is good and inflation is coming down and central banks will cut rates. So overall, equities in this type of backdrop should make progress. So we have to be clear on the growth side, which currently is a bad thing, like the retail sales you were mentioning. We are still having a lot of positive news flow that can be supportive for equities. But also important is outside of the US, actually inflation pretty much everywhere is coming down. And I think you mentioned the labour market this morning out of the UK. I think generally the macro picture outside of the US has been weaker. And generally that eventually should mean there's a bit for the bond market emerging. You should stabilize the yield levels. So growth is good. Yields eventually find their equilibrium and you will get some cuts, probably not as many as people were hoping. All of that should be making equities stabilize and equities can make progress. Are you going to get as strong returns as you had at the beginning of the year? Probably not. There will be some moderation.
Christian, it's Kriti. Talk to us about where the bond market fits into all of this. If there's an expectation of higher yields in the near future, what incentive is there to hop into bonds right now?
I think as a near-term investor, you have to consider how much yields can go up, and that costs you relative to really what the bond market can do for an asset allocation kind of portfolio. And the fact is, if you look at a 300-year history of the US 10-year yield, is a decent history. You could argue from the beginnings of the US, really, the average is actually 4.6, which is more or less where we are. If you take out the 70s, the average yield is 4.4. So you have to ask yourself how much further, especially in the medium term, 10-year yields will go to kind of be a drag on fixed income allocations relative to the benefits you're getting. The benefits are a real yield, which is reasonably attractive. The closer you get to 2.5, I think that's the level we've been saying that it's a bit of a speed limit for the bond market to sell off further. So 2.5% real yield, that's actually slightly above average, and it's a pretty decent yield in the world we live in. And on top of that, you have to consider that there will be protection value when you need it. I think we have several indications this year that, for example, when you have Middle East tensions, geopolitical shocks, but also selective growth shocks, that the bond market will buffer in these scenarios. Doesn't feel like you need that right now with the data, but that might change in a few months. So I think the longer your investment horizon gets, the more you want to think about the bond sell-off right now as an opportunity to maybe get to the type of bond allocations you want to be in the medium term.
Well, that's my question there, Christian. You're talking about it serving as a sort of buffer in your portfolio, even in the face of just geopolitical risk. But we're seeing the exact opposite. In fact, you're seeing incredibly weak auctions in the same week that you had attacks on between Israel and Iran. You had, of course, concerns between Russia and Ukraine, not to mention the various other geopolitical conflicts around the world. Geopolitical risk is increasing, and yet bond demand isn't. How do you square the two?
I think it's a great question. I think there's a few things at play here. I mean, first of all, the geopolitical tensions as of now have been remarkably contained. And even in the kind of commodities markets, the spillovers have been relatively limited. So I think the challenge is we've been through a few geopolitical tensions. The market has maybe become a bit desensitized, especially because the immediate kind of second round effect, the immediate shock isn't as clear. But I would still say that if you have a serious escalation, the bond market would react. And with regards to the auctions you were mentioning, I think that's a concern we've had since the summer of last year, that there is a lot of issuance coming and investors need to be incentivized to buy these bonds. The incentive can come via a flight for safety bid, or it can come via the yield. We know there's like roughly 8 to 9 trillion in money market funds right now. And I think that's part of the process of luring these kind of 8 to 9 trillion to extend duration to buy longer dated bonds that you push up yields a bit.
Let's talk a bit. You mentioned just a moment ago maybe owning bonds for some insurance. that at some point there is going to be a problem, that at some point that we're going to need those bonds. Does the no landing scenario ultimately lead to a hard landing scenario? Because that's going to be the worst case scenario, certainly for risk assets right now. And if I'm thinking that's kind of the trajectory we're ultimately on here, that higher for longer ultimately means the economy gets hit harder, when do I start to think about that? How quickly can that kind of evolve throughout 24 and into 25?
Yeah, I mean, you want to think about tactical and strategic allocation. Yeah. When I said earlier with the medium-term outlook, you want to think about adding duration. That's the strategic asset allocation discussion. Yep. The tactical allocation discussion is a tough one. We know that. Timing recessions, timing big bear markets is very difficult. We are late cycle. And you can see that in a variety of metrics. The unemployment rate is very low. The output gap is positive. You have profit margins being elevated. The equity risk premium is low. Credit spreads are tight. These are all telling you...
That's quite a list.
These are all telling you a late cycle, but it doesn't mean that you should worry on a tactical horizon. You can be in such a backdrop for a very long time. The thing I'm watching in particular is the private sector financial balance. That's the overall health of the economy. Yep. Households and the private sector.
What's that telling you?
Right now, it's very early cycle. Like, you actually have very little leverage in the household sector, very little leverage in the private sector. That means that this late cycle backdrop could last a long time. So what I'm saying is, in a tactical horizon, we're not worried about needing bonds, if that makes sense, at least with regards to the U.S. economy. But there can be global geopolitical shocks. We have to admit as well that Europe has been a bit on a weaker footing. Improving. We have to be clear, we're going through a global manufacturing recovery. We also see that in the China data. I think it does feel like there's a variety of improvements on the growth side outside of the US as well. But I would say that unanticipated shocks, they're always something that can help the bond market perform. And generally, I think the longer your investment horizon gets, I agree with you, the longer you are on a late cycle backdrop, the more you worry about imbalances occurring, re-leveraging, and eventually that creates vulnerability.
That's why you buy insurance. Christian, nice to see you. Very nice to see you. Christian Muller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Thank you very much indeed. Ugly start to European equity trading this morning. Let's look at the kind of the core stocks that we watch every day just to kind of get a read on what is happening here. Look, you can see it. Look, it's really interesting going left to right on that screen in terms of what is happening. Nova down, LVMH into its numbers later down, Ferrari soft, ASML nearly 2% to the downside. Schneider's even lower than that. That's the kind of the AI trade that has been priced in there. Then you look at Nestle on the right-hand side of the screen. Verve offers kind of some defensiveness this morning, some opportunity maybe to seek some safety. So Nestle only down by 0.3%. What else are we watching? There's some interesting moves elsewhere that we need to be paying attention to. Joe, over to you.
We're going to start with one of the very few stocks that are green today, because 90% of the stock 600 is in the red this morning. But one stock that is leading the gains is Ericsson, jumping around 6% over in Stockholm as their earnings beat expectations. They are finally predicting a bit of a recovery in margins, given that some of their customers coming back and putting in orders. We saw a read-through in Nokia rising at the open, but giving up those gains already, given the downturn in broader markets, and not seeing that sustained feed-through. But Ericsson, a clear outperformer today, up 6% at the moment. We'll flip over and have a look at a couple of UK stocks. We did get that higher than expected wages number out of the UK, but then the unemployment number also higher, taking the sting out of it. But red on the screen in terms of the banks and also the home builders as well, and a couple of single stock decliners to bring you. Take a look at Doc Martens, down another 25%, yet another profit warning from the maker of boots here in the UK. More bad news for them. And TransferWise, we had in stocks to watch another slowdown in their payments, falling further below that IPO price that we showed it had recovered to earlier. Both of those stocks slammed today. We'll then take a look at a couple of others. We're going to bring up UBS very quickly, because this one, there was a report out on the Swiss finance minister talking about the financing needs at UBS. Potentially they need more capital. Tens of billions is what's being speculated by analysts, and the finance minister kind of reiterating those concerns. Down 2.8%, potentially, though, more to do with the broader market move today. Quick look at paper. We finally got confirmation of this takeover deal. DS Smith and International Paper doing that merger that has been speculated for a long time. DS Smith actually declining, though. Potentially people wanted a higher price catalyst for that. Mondi was the rival bidder, and that one getting a little bit of relief today, up 0.4%. At the moment. We'll take a look at a couple of others. We've got a few morning calls to bring you as well. We did do IAG over in the pre-market stocks to watch. There it is on the screen. So Citi predicting a recovery. They do have a buy rating on that stock. It is a positive catalyst for them, but can't catch a break. The broader market dropping. IAG down 1.5%. Finally, one more to bring you is Swatch, the watch retailer. This one is negative. It's over at Morgan Stanley, downgrading their price target to a street low. It's 190 Swiss francs. It's trading at 196, down 2.4%. They say Swatch is too exposed to the low end. You're better off buying Cartier watches, Richemont, that kind of thing. Avoid Swatch, according to Morgan Stanley, and that stock down 2.2% this morning.
Buy a Cartier. Joe, thank you very much indeed. Joe Easton joining us from our equities team. Equity markets look a little like this. Little catch-up trade this morning. Certainly no dip buying happening. Equities are down fairly solidly here in Europe, as you can see on the screen. Up next, we're going to talk about Wall Street banks. We'll do that in just a moment. Another big day coming up. This is Bloomberg.
We feel very good about our first quarter results, which reflect the strength of our world-class and interconnected franchises and the earnings power of our firm. This performance was aided by the swift actions we took last year to narrow our strategic focus and play to our core strengths.
Stick to what you're good at. That seems to be the lesson for David Solomon, the CEO of Goldman Sachs there, speaking about the bank's first quarter results yesterday. Retail's gone. Trading is back. The numbers reflect it, but is it sustainable? So we got Goldman Sachs yesterday. The numbers were good, recording a 28% jump in net income in the first quarter. Now we get Bank of America. Now we get Morgan Stanley. Is there a read across? What do we learn from JP Morgan? Jenny Serene joins us now to talk about this. Let's start with Goldman Sachs. Stick to what you're good at. You're very good at trading, clearly. Retail less so. Is Goldman Sachs back, and is it sustainable?
I mean, I think that's definitely the message from yesterday. So, yeah, when you stick to your knitting and you stick to what you know best, the results look really good. I will say this is an environment that kind of plays to those strengths. So, especially when you look at how JP Morgan performed on Friday, this is a bank that has been, quarter after quarter notching just huge gains in net interest income. Now that rates are poised to fall, that's a business that kind of gets on its back foot. And so you start to look at things like trading, investment banking, capital markets origination. And so I think that's what you see here just even more clearly is, Goldman is a bank that kind of does well in that environment. And so you really see that divergence between these two banks.
Jenny, what kind of precedent does that set for Bank of America, for Morgan Stanley? You made the comparison with JP Morgan earlier. How much of this story is a Goldman story as opposed to a banking story?
I mean, I think it's a really good question. It's definitely a great day to look at it because Bank of America obviously is very similar to JP Morgan. They rely very heavily on their consumer banking arm. Net interest income has been a huge win for them these past couple of years. And so it'll be interesting to look at how they compare to Morgan Stanley, which is definitely much more like a Goldman-type Wall Street-focused bank. And so I think, later today when we get those results, you'll probably see that same divergence that we've been seeing so far this earnings season. But it also will be a good tell as to whether or not, Goldman's results on trading, is that really kind of that Goldman magic that they like to think they have? Or is that, something that the entire industry is kind of benefiting off of as, volatility kind of ticks back up here and folks are really keeping an eye on what the Fed is set to do.
Jenny, great stuff. Thank you very much indeed. Looking forward to the coverage a little bit later on. It's going to be fantastic. Shanali, etc., the rest of the team really delivering a little bit later for you as we work our way through these numbers on Wall Street. Let's turn to the big story that's coming up a little bit later on here in Europe. LVMH sales and revenue is going to drop a little bit later on. Expected maybe to be a little bit muted. China's going to be really interesting to see how the Chinese story is developing. Is that the driver here, one way or the other? Well, let's figure out exactly what we should be expecting. Andrea Felstead from Bloomberg Opinion joins us now. Andrea, we saw a warning a few days ago from Kering. Hermes is absolutely flying. Which one is LVMH? Is it Kering or is it Hermes?
I think it's more like Hermes. It's less like Kering. That doesn't mean it is Hermes.
Yeah. OK, so in terms of what we're expecting later, what are we looking at?
Analysts are expecting about 3% organic growth for fashion and leather goods and group overall. Now, this time last year, first quarter of 2023, both of those were in the high teens, and they were about double what analysts expected. Now, we're up against very strong comparisons because this time last year China was just reopening. The US was starting to slow, but it hadn't really turned down. Now we're looking at a much lower figure. If it is around 3%, I expect it will beat slightly. That will be the lowest since 2016.
Andrea, there's a lot of gloom and doom, it feels like, around luxury broadly, but LVMH in particular, and yet you're seeing the stock move over 20% since the start of the year. How do you square that?
I think analysts and investors got too excited. Bernard Arnault said in January that we were seeing a gradual deceleration, a normalisation in demand after those 3 blockbuster years. Rather than falling off a cliff, investors who had sold the sector on weak earnings last autumn rushed back in. But I think it went up, too fast, too soon.
In terms of the China story, we've seen Chinese retail sales data today. They don't look great. The Chinese consumer is struggling right now. There isn't the travel that there once was. Is China still the swing factor when it comes to a set of numbers from LVMH? Is it going to be the swing factor this time?
It's going to be both. I think it's going to be China and the US, because the US has become a much more important part of luxury. So you've got those two. And the idea was the US would slow and China would pick up the bling baton and run with it. And that hasn't happened. So what you've got both of them fairly muted. So that's quite a tricky situation for the groups to be in.
Andrea, are we watching at all this kind of flipped mentality? You were talking about this kind of American slowdown. You're seeing American resilience instead. When does that show up in these numbers?
I don't think it's yet. Investors really are looking for the US to rebound this year. And as you say, there are some quite good signs. Luxury demand tends to be more correlated with stock markets, and also in recent years, crypto. Both of those have been pretty good. We've seen prices on the secondary watch market stabilise. That could be an indicator. So definitely the US is the big swing factor. It's stabilising. It hasn't yet recovered.
Andrea, we'll look forward to the numbers a little bit later on. I know you're going to be writing some fantastic pieces for us to read on the back of it. Bloomberg Opinions, Andrea Felsted. Quick look at the markets. This is what equities look like this morning. It is a negative session thus far. We are certainly pricing in yesterday's Wall Street sell-off. Equity markets have had a great run, though, so I think you've just got to see this in the perspective of what we are looking at here. But certainly some pressure being put on European tech stocks this morning. European luxury stocks are under pressure as well. So that is where we are seeing some of the weakness coming through. In terms of the bond market story, we're looking at yields going higher once again in the United States. They are fairly flat here in Europe, so that's another factor you need to think about. But in terms of what we are watching this morning, I think you kind of need to think about the reset for the rest of the day. What is it going to be? What are we looking at here? Is it just a kind of little bit of repricing? When does the market look forward and reprice maybe a more flattish session in the United States a little bit later on? We'll talk about that next. This is Bloomberg. Morning, folks. 30 minutes into the trading session. Tuesday the 16th turning out to be fairly ugly from the get-go, really. I think we knew this was going to happen. We saw what happened yesterday stateside. It's one of those mornings where you feel you need to stand up. So that is what I'm doing. So I'm going to talk you through what we're looking at here. It's a pretty consistent picture. FTSE, DAX, CAC, all down, let's call it 1.2, 1.3% across the board this morning. There's very few sectors in positive territory. The telco sector is one of those that is rising, but pretty much everything else is in negative territory. You've got some big names that are putting on some fairly decent-sized losses first thing this morning. Now, what is interesting here is that US futures are fairly flat right now. So at some point, Europe's going to get through the pricing of the session yesterday and start looking forward to the rest of the day. When does that happen, I think, is going to be an interesting story. We'll see what kind of the early indications look like as we start seeing desks filled on Wall Street. So that's the picture at the moment. DAX is down kind of 1.5 now. FTSE's down 1.3%. So we're getting a little bit more negative. So let me show you the two-day chart. I show you the two-day chart, of course, because I want to show you what the gap looks like first thing this morning. And you can see that gap there. We were trading softer into the close yesterday, but that's the repricing versus Wall Street that we've had to do this morning. Critically, we are below 500, so keep an eye. That's been a kind of important line that people have watched out for now trading 499 on the stock 600, and we're down by around 1.2%. There are some single stocks that are actually looking a little bit better, Kriti, and it's probably also worth taking a look at what is happening with the bond market.
Yeah, it is. I'll pick it up from here. When you look at the bond market, though, it feels a little bit more sanguine than perhaps some of the kind of pain you're seeing in the equity market. Let me walk you through it specifically when you look at the German yield picture, for example. Unchanged. France, unchanged. Italy, even, the kind of volatility you traditionally see in the periphery, not really showing up there. You are seeing a little bit of a pickup in the gilts market, but again, not one to write home about. That largely a reaction to what you saw with that stronger wage data as well. But again, let's bring it back to the equity market, because again, to your point, that's really where you're seeing the sell-off. There are some big stories to be watching, though, and Ericsson, I think, tops the charts when you talk about which ones are really worth watching. Ericsson kind of having a little bit of a mixed message here. They came out this morning and actually said their earnings weren't that great in particular. When you look at the profit numbers, they came in stronger, so their margin improvements are better. But in terms of the overall sales, their overall kind of units, that's where you see the demand drop. In fact, they talk about a 27% slump. They had that issuing a little bit of a forecast that is a little bit negative, but it's that profit improvement that's really helping investors get to about a 5.8% increase in the stock this morning. I was sad to say that's the only green on the screen you're seeing this morning, kind of in line with what Guy was saying. Let's talk about the UBS story, down about 3.4% this morning. And this, of course, coming off the idea that they are expecting more kind of capital expenses. And that's really starting to see a hit there. A capital hit of as high as $25 billion, according to one Swiss minister. So seeing a big move there as well. Doc Martens is another one that we keep an eye on very, very closely. And those shares down a whopping 28%, hitting a record low. And that, of course, coming in a profit warning as well. It's that forward guidance that really matters, saying is we're going to see a challenging 2025. And lastly, Wise, this is the one that Joe Easton, our equities reporter, was talking about earlier. They're coming out missing their revenue estimates, their income guidance coming a little bit higher. They're seeing those interest rate growths. The customer growth is helpful, but ultimately, net, they did not meet the line that the analysts set out for them. Those shares down about 8%, Guy.
No soft landing for Airware. DM down hard this morning. Kriti, let's talk about the kind of the wider market story now and get some perspective on where we're going from here. Maria Veimana, head of equity research at State Street Global Markets, in London today. Very nice to see you.
Very nice to be here.
Yes. You've been talking to me over the last few months about your strategy, and I'm wondering kind of how it now stacks up against a world that feels like it's changing a little bit. You've been long cash, you've been long tech. How do you think about that trade this morning in a world where maybe yields are going towards 5%? Looks like we're going to get no landing, certainly in the United States. Is that still the right trade?
I mean, the reason we liked cash and tech was really kind of this economic scenario when we have no lending. But, I mean, to us, no lending means no lending and then crash. You still need to land the plane. You run out of fuel. And I think we're beginning to see this kind of non-lending story. And bond yields are rising, so, I mean, stocks really don't like it. And so cash part of the story is helping. I mean, we still think tech is good because it's still one of very, very, very few areas where we can have earnings growth. And I'm sure you'll ask me a lot of questions on earnings, but looking at earnings expectations, it's really tech. We have something. So to me, that's appealing. So cash and tech is a good combination.
Okay, so you bring up the earnings, so let's go there. The equity market's had a great run.
Yeah.
The headwinds are mounting. Geopolitics, there's a long list right now. Are earnings going to be a catalyst, or are they going to be a good enough catalyst to get us over kind of all of those other issues? What are you looking at?
I mean, I like to think about earnings as kind of macro versus micro.
Yep.
On macro level, and that's what we saw in Q4, earnings were good enough. In aggregate, earnings grew great. We're not in recession. But under the surface, it was just tech. And that's why tech managed to lead. So that's why large cap companies managed to lead. And that was the distinction, large versus small. Large companies are able to deal with higher interest rate. Their financing costs are a lot lower. They more diversified client base. So, and I think that would be, again, this macro versus micro story. So bigger companies, more stable earnings, more stable growth. They can deal with a difficult economic backdrop.
Yeah.
Smaller companies really challenged.
Maria, how much of the moves that we're expecting, or we've seen at least in the last week, overnight especially, coming in the next couple of weeks, are really some sort of retracement, just taking a little bit of steam or a little bit of momentum out of stocks, as opposed to some sort of fundamental concern?
Yeah, I think, ultimately what's driving stocks in aggregate is this kind of volatility backdrop. For a long, long time, we had a very low volatility environment as kind of market believed in this soft landing idea that despite everything, we're still having interest rates being cut very soon in a synchronized way. And then we have like economic recovery fairly soon. So that was the belief, and that kept volatility low. And market, it's really interesting over the last months. We had a lot of data that challenged that, but market was able to shake it off and kind of continue fairly strong, fairly benign environment with momentum stocks leading. So for now, we haven't seen this kind of narrative. Maybe we're just beginning to see it's a little bit kind of questioned. But for as long as volatility stays low, stocks tend to do well and kind of on a macro level. Under the surface is a different story.
Maria, how does that break down regionally, for example? If the United States is setting the precedent, or it's these kind of catch-up trades, for example, that we're seeing in Europe, is there some sort of capital flows or fund flow story you're seeing from Japanese equities, for example, to other parts of the world?
Yeah, for us, U.S. is still by far the best market because, as I said, we love large cap quality stocks. They tend to live in U.S. So that's a positive story. We worry that momentum stocks will really struggle in an environment where economy is slow, so that's definitely not Europe. Japan is big question mark. It's obviously been supported by weaker yen, but if that support going away as BOJ is getting more active, then we'll start questioning that more. Emerging markets, they don't look particularly attractive if we think that recession is coming. So it's still, we're kind of stuck with US and few kind of select countries, but there are not many.
Am I hedging the upside or the downside at the moment? What am I doing?
Well, cash and tech.
Well, yeah, okay. So that's the trade. But it's interesting. The VIX is picking up now.
Yep.
If I look within the skew, what kind of it looks still. It's become a little bit more balanced. It was very much people hedging the upside.
Yep.
Does this feel like a nervous market right now? You talk about sort of volatility. We're at 19 on the VIX right now. We'd be much higher than that over the last few years. If you're looking at the options market, what are you seeing and what do you think you do?
I always want to hedge downside, especially if it's that cheap. Why not?
But the trade it's been the FOMO trade. It's been hedging the upside that most people have been doing recently. If you look at the skew.
Yeah. I don't know. I worry about recession a lot more than others, I think.
Yeah.
So
and how close do you think that is? You talked about the kind of running out of fuel and the hard landing. I was talking to Mark Cumber about this a little bit earlier on. It feels like we're getting into the no landing, hard landing scenario. But we were talking to Christian Muller-Glissman. He was saying that this phase could last quite a long time. So how long do you think this phase lasts for? And this really goes to kind of why I'm asking about hedging the upside and the downside. How long do I... when do I alter that mix in terms of at the moment I'm looking at a fairly kind of decent market that could potentially go up for a little bit longer, but I'm kind of wondering what the timing, the tactical trade looks like around.
Yeah, I think it's a brilliant question because I think part of the economy is already in recession and there are parts of the economy that are not. So being kind of equity analyst is actually brilliant because you can kind of do both. So it's difficult to do on an index level, but if you're looking at like sectors and styles...
So how would you do it below the index level?
Large cap versus small caps, that's the easiest trade.
Right.
Obviously, small caps have been really struggling. And actually, that's the question I get asked most often. Do I buy small caps? They're so cheap.
Yeah.
No, don't. Because if recession is coming, that's a place where most pain will be. Do I buy value or growth? Do I switch? Do I buy cheap stocks? No. It's really difficult for a strategist to come to a client and say, no, stay with expensive momentum stocks. But I think that's the trade. You have to stay with companies that are able to produce earnings. It's quality. Yes, it's expensive, but at this stage of the cycle, you absolutely have to pay for it. And so that's your recession trade, ultimately, because you're buying expensive quality, right?
Yeah.
You wouldn't be buying it in normal time.
How long do you think this last phase lasts for?
Until we get into the recession.
How much fuel is in the tank? How much fuel do you think that? How much the U.S. consumer looks like still very risk on, wants to buy stocks, wants to be risk on, wants to go out to the shops and spend money. How long does this? I remember the build up to 2000. It feels different but similar, and I'm wondering kind of how long this last bit lasts for.
I mean, it can. So the things I'm looking to kind of answer this question is bank lending. So we know C&I lending, that's negative growth already for a couple of months. If you look at consumer lending, I mean, one of very few places where consumer can borrow is credit cards at 20+% interest rate. So to me, that doesn't sound like it can last long.
No, that's a punchy number.
Yeah.
Okay. Well, certainly at the moment they may be willing to take that risk, but with the employment story as it is.
Exactly right. Exactly right.
Maybe we'll see.
Yeah, exactly.
We'll see how that. Lovely to see you in London.
Yeah,
come and visit us more. It's nice to see you in Milan, but it's nice to see you here as well.
Absolutely.
Maria, great stuff. Maria Vetmana, head of equity research at State Street Global Markets. Thank you very much indeed. We need to talk about the China story as well this morning. You got to remember that the German Chancellor Olaf Scholz is out there. He's been meeting the Chinese President Xi Jinping. Apparently a tough line taken on trade. The Chinese economic data this morning also fascinating. We'll deal with all of that next. This is Bloomberg. Tuesday the 16th, with 45 minutes into the session, this is what the equity market looks like here in Europe. As you can see, fairly negative picture. We priced in a little bit at the back end of the session in Europe. When I say pricing it in, we priced in the US sell-off. Kind of back end of the European session. We had more to do this morning, which is what we've done this morning, and that is why you're seeing the red on the screen first thing today. It's been around the Euro Stoxx is down 1.4. Australia was down by 1.5. FTSE's down by 1.3. SMI's down by 1.2. Names like Nestle may be providing a little bit of support for the Swiss market this morning. Widening the lens a little bit, we probably should talk about what's been happening in China overnight. The Chinese data wasn't particularly good. The GDP number initially looks good, but it's kind of veneer thin in terms of what it tells you about what's happening below the surface. Take a look at what's happening with iron ore this morning. Take a look at what's happening with retail sales as well. And it's this kind of economic weakness, which is the backdrop that Olaf Scholz is facing in his trip to China. The German Chancellor is there. He met with the Chinese President, Xi Jinping, a little bit earlier on. Now, we've obviously got these trade tensions mounting, and the backdrop to that is the data we're seeing out of China. China desperately wants to export its way out of that slump. But we've got to talk about what is happening with the geopolitical story as well. Let's talk about all of this, bring it together. Ollie Crook joins us now from Berlin. Ollie, what can you tell us about the tone of the conversation between these two a little bit earlier on? We saw a very tough line being taken by Janet Yellen a few days back. Is Scholz mirroring that, or is the line a little bit softer?
I think it's a little bit softer, Guy, but I think tone is the right kind of terms in which to talk about this meeting, right? Because on the one hand, Germany is in some sense the strongest ally, certainly economically, to China within Europe versus at many of the other European countries, but at the same time, so acutely familiar with the risks of being over-dependent on another economy, let's say Russia and Russian gas, and really challenging the kind of the hallmark of economic and diplomacy of Germany under Merkel. You know, we're far from the change through trade days that we used to see, where you had really exuberant conversations with executives going to China, big smiles. This was much more somber. I mean, the tones, and if you listen to some of the readouts from the conversation, Scholz saying that both China and Germany are trading nations that benefit greatly from the World Trade Organizations. They're committed to strengthening rule-based system. Right? And then Xi on the other side saying that as long as we have principles of mutual respect and search for common ground, despite differences, we can continue to develop this relationship. That is not really very sort of warm language, but it's saying, sort of acknowledging the reality that we are dependent on one another and we would like to continue to benefit, but maybe not as previously at the exception of political goals.
It's interesting. Some of the kind of the numbers, the currency all starting to sort of look like actually kind of that initial entry into the WTO that China made all those years ago. Let's talk about the kind of the rules-based system. The Europeans are clearly very nervous, as are the Americans, about what is happening in key sectors. We're seeing investigations in Europe. We're stepping up those investigations into a range of subjects, including the auto sector. What are the Chinese looking at in terms of how those investigations are going to develop, and what do they do about it?
Yeah, guys, so what's really interesting is obviously the EV one is certainly the most significant one in terms of the economic impact, but you have other ones that have been opened up by Europe, right, into wind energy, into solar energy, where basically the industry in Europe has died for the second time because they basically have been outpriced and outcompeted by China. And what Xi Jinping will say, I'll read a quotation from what he said exactly this morning. China's export of electric vehicles, lithium batteries, and solar products have enriched supplies to the global market, relieved pressures of inflation, as well as made great contribution to global efforts to climate change and the green transition. So really the way that China sees this is, listen, we got ahead of this. We got a raw material policy in order. We've got all of these sort of things aligned in order to do it. Europe is obviously saying you're doing it unfairly, too many subsidies, too much of a tax break. But the issue that Europe is going to encounter is, a question of consistency. I mean, there's the Inflation Reduction Act in the United States. Are there no problems there? Does this sort of feel a little bit, biased? And there's a question of how much of it is legitimate competition, how much of it is unfair competition. And then the last point, Guy, and this is going to come into focus later this week with EU leaders meeting in Brussels to discuss this exact problem, European competitiveness. How can Europe become more competitive on its own? It needs to get that. It needs to get that in order itself.
All right, Bloomberg's Oliver Crook in Berlin. We thank you so much for walking us through some of the conversations that are going to be between Germany and China. But I want to continue that conversation because I really want to hear the European perspective. It's simply from the folks that are actively working on it. I'm very excited to bring in a special guest. We are now joined by the Director General of Business Europe, Marcus Beyer, joins me right here in Brussels. Marcus, we were just talking with our kind of European correspondent, Oliver Crook, there about what this threat looks, what from a geopolitical, from a kind of policy perspective, Olaf Scholz and Xi Jinping can potentially talk about. But from your perspective, you work with so many businesses, you advocate, you consult with some of the folks at play. What is the threat you are seeing? Can you kind of quantify that for us?
Well, I think the issue is that Europe is still leading in many aspects, like we're still leading in high-tech exports. But the truth is also we have been falling behind these last years, and you can see it in all figures. I mean, we have a weaker growth than the US or China. I mean, we have a low productivity growth. We have less industrial production development, and we have also a reduction in jobs in industry. And there's reasons for this. We ask our members, where is the reasons? And the main reasons they give us is the high energy cost, the cost of energy, which is comparably too high to our competitors, and the other aspect is regulatory burden. So meanwhile, we talk a bit like of a regulatory inflation or a regulatory tsunami. So there's a couple of things we'll need to do to bring the continent back on track. We think it's totally doable, but it's time to wake up and time to do our homework.
But what are you addressing specifically? Is this a China thing? Is the United States thing? Are we waiting for election risk? Where's the threat coming from?
Well, I think, of course, the world has become a much more competitive place, and the fact that there's so many geopolitical tensions is certainly not conducive for a business model like the European one. Yeah. But I think the main point is that we have not done all pieces of our homework. I mean, we have done all kinds of things and might have lost a bit the view on the necessity to stay competitive and, of course, the necessity to make sure that our economy stays strong, because Europe is always a strong player in the world when our economy is strong. And there's a couple of things we need to do. So we need to find answers to the too high cost of energy, going beyond what we've done so far, beyond the electricity market design. We need to reduce regulatory burden. There's first steps, but more needs to be done. We need to speed up our permitting procedures. I mean, our companies tell us, even if there's money, it simply takes too long to get the production site on stream or to have infrastructure done. So there's a long list of things which need to be done. The European Council, the politicians start to address it. They talk about the new European competitiveness deal this week in the Council. That's a good thing, but it can be a first step into a new phase of working in the direction of bringing the continent and the economy back on track.
For a global audience, we should mention that the noise you just heard was a little bit of drilling that we're doing, a little bit of renovation. But to your point, I want to bring it right back. When we're talking about what the hiccups here, it feels like capacity shortages may be an issue, specifically when it comes to how European companies can get access to things like raw materials in China, access to supply chains, access to even talent when it comes to things like technology. What needs to happen to ensure that that supply chain story, whether it's from a labor perspective or whether it's from a physical perspective, happens?
Well, the supply chains is a crucial issue, and having the critical raw materials, the metals, all this is key. So on this we need to do a double act. So meaning we need to improve the capacities to mine and process in Europe. This is what we are doing. At the same time, it's very clear that the main chunk will stay imports.
Yeah.
So therefore, what we need is to diversify via ambitious free trade agreements and the free trade agenda, diversify, of course, our export markets, but also our import markets, and have raw material agreements with raw material-rich countries to have a choice.
But diversify with who? Because when I'm thinking of diversifying with raw materials, immediately there are a couple of names that come to mind. China, Russia, India, in terms of raw materials. Two of those three names, Europe is not exactly on great terms with at the moment, especially given some of the sanctions that are being put towards China. Obviously, Russia not being a part of the photo. Where do you kind of diversify? Where are those free trade agreements coming from in terms of raw materials?
Well, to give you an example, I mean, of course, Russia is a specific issue at the time being because there are sanctions and where the whole G7 is united to act in this direction. With China, I think Europe is working for a new balance, and obviously China will remain an important source. But there's other possible places, starting with South America. We have just more or less finalized our free trade agreement with Chile. I mean, this is very much about lithium. There's the Mercosur possibility, so South America is part of the answer. If I look at what comes from Russia, South Africa would be part of the answer, and I would say the more, the better. So we need a choice to avoid what we had in the past, that you exclusively depend on some markets. And of course, India is also something where Europe is negotiating. It's not an easy negotiation, but obviously this is something which would be certainly in mutual benefit.
Yeah. Well, certainly something we'll be watching very, very closely. Markus Bayer, we have to leave it there. He, of course, is the Director General of Business Europe. Guy, talking to us a little bit about where these agreements are going to be coming from. How does Europe get competitive? A lot of it just comes from sourcing and alliances that are not necessarily traditional.
No, we've learned some big lessons over the last few years. Certainly Germany has in terms of its reliance on Russia when it comes to that resource story. Kriti, looking forward to having you back in London tomorrow. Great work today in Brussels. Kriti, talking of Brussels, I just want to flag an interview as well, which I think you and many others will be paying attention to. Mairead McGuinness is going to be joining Bloomberg Television a little bit later on. Now, Mairead is the European Commissioner for Financial Services and the Capital Markets Union. The Capital Markets Union is absolutely pivotal now and being pushed hard. If Europe wants to finance the green transition, if it wants to finance the rearmament story, Capital Markets Union is being seen increasingly, and private capital is being seen increasingly as being hugely important. Jeremy Hunt is also over in the United States, and he's going to be joining Bloomberg Television as well. He, of course, is the Chancellor of the Exchequer. Today we see data that wages actually reasonably sticky, but the labour market is softening. What does that mean in terms of his party, his prospects going into the election? All of that is going to be discussed a little bit later on. Francine is going to pick up the baton from here. European equity markets are under pressure. The significant sell-off we're looking at this morning actually revealing some quite big numbers on the screen in front of you. This is Bloomberg.